Welcome to the Deep Dive. We're your shortcut to getting smart about the latest earnings calls. Today, we're digging into Ulta Beauty. Their Q2 fiscal 2025 call just happened, August 28th. We've gone through the reports, the call itself, analyst takes, the works. And we're here to unpack their performance, some pretty interesting strategic shifts, and the market's reaction, which was notable. Our goal to make sense of this whole constructive but cautious vibe coming from them. Okay, so let's start with those Q2 results. Picture this. You open the report, and basically every number blows past expectations. That was Ulta this quarter. GAAP diluted EPS, $5.78. That's like 13% better than consensus. Revenue hit nearly $2.8 billion, beating by about 4%, and up a solid 9.3% year over year. And maybe the key one, comparable sales growth, a really strong 6.7%. Driven by more people shopping, that's transactions of about 3.7 points, and people spending more. Average ticket up 2.9 points. These are fantastic numbers, right? But the stock still dipped the next day. What's the story there?
Yeah, it's a great question, and it really frames our whole discussion today. Those headline numbers are, undeniably good. Ulta definitely showed up. But what's fascinating, like you said, is even with those results and them raising their full-year outlook, the stock dropped. Over 7% the day after. It's that classic sell the news thing, isn't it? Suggests the market wasn't just looking back at Q2, it was looking ahead, maybe with a bit more skepticism. And that's why we're calling this constructive but cautious. Investors seem to be weighing those future concerns pretty heavily against these Q2 wins. We'll get into that.
Okay, let's unpack that Q2 performance itself then. The CEO, Keisha Steelman, she pointed to their Ulta Beauty Unleashed strategy. Sounds like more than just a slogan. They're talking better store execution, smarter marketing, operational tweaks, and just compelling products and innovation. Seems like it's clicking with customers. They hit a record 45.8 million loyalty members. That's up 4% from last year. In this market, how important is locking down that loyalty base against, Sephora, Amazon, even TikTok Shop?
Oh, it's absolutely crucial, foundational, really. The beauty world is getting, more fragmented, more digital all the time. So holding on to those customers with a strong loyalty program, offering both mass and prestige stuff, having that seamless online, offline experience, that's their defense. It's their moat, you could say. It builds a community, not just transactions, plus all that data they get. Super valuable for personalization, which, drives more spending.
And looking at what people done. Performance was strong pretty much everywhere. Fragrance was the star again, strong double-digit growth. Helped by Mother's Day, Father's Day pushes, and some big new launches, celebrity stuff too. Skincare and wellness, high single digits. Body care, wellness generally, K-beauty expansion, all contributing. Makeup saw mid-single-digit comp growth. Good signs in both mass and prestige, lots of new products helping there. And hair care, also mid-single digits. Pro hair care, accessories, tools, doing well. They're constantly adding new things, 24 new brands just in Q2, many exclusive. And people already talk about upcoming launches like Pattern Body from Tracee Ellis Ross and Rihanna's Fenty Skin. How does all this newness fit into their competitive strategy?
That constant stream of newness, especially the exclusives, it's a really critical growth driver. It keeps things fresh, right? Gets existing members excited, pulls in new customers chasing the latest trends. When you land exclusives like, say, Isma by Shakira or Fenty Skin, it's not just about the sales dollars. It boosts their cultural relevance, their brand authority. That's huge against giants like Amazon or even the curated feel of Sephora. Exclusivity gives you a reason to go to Ulta specifically.
And it's not just products. Their marketing is shifting too. Reimagining events like Here We Glow Sun or the Only at Ulta push for exclusives. And trying to boost cultural relevance, like being the official beauty partner for Beyoncé's tour. That's smart. Big reach there. Their digital game is strong too. More automation, real-time content, better personalization, things like split cart, replenish and saves. But this stat really jumped out. Half of all e-com orders were fulfilled by stores in Q2. Half. That's their highest rate ever. Really shows that omnichannel integration working. So they're nailing the core stuff, clearly. But they're not just sitting back. What are the big, transformative moves they're making?
Right, it's clear they're not just tweaking things. They're making some pretty significant strategic plays to scale up and shift their foundation a bit. Probably the biggest headline is international expansion. They closed the Space NK acquisition back on July 10th. Now, Space NK, for anyone not familiar, is a big deal in UK specialty beauty. 83 stores, online presence in UK and Ireland. This is huge for Ulta. It's a less capital-heavy way into a major international market. They're buying an established player, not starting cold. And it's not just the UK. They had a soft opening in Mexico for a store there, and plans for the Middle East later this fiscal year. It's a multi-fronted approach. Then there's the whole wellness expansion. They're being really explicit. They want wellness to be a billion-dollar business over time. They see it as a huge growing market. And it's not just, vitamins anymore. It's curated self-care. They've rolled out the in-store wellness shop to 370 stores already. And another 50 stores are getting an even bigger version in Q3. We're talking over 150 brands, 700 different products, or SKUs used. That's serious commitment. And then coming soon in Q3 is the Ulta Beauty Marketplace.
Yes.
This is going to be an online platform curated invite only for sellers. It lets them broaden their assortment online, more beauty, wellness, even lifestyle stuff on Ulta.com. It's a way to boost their authority in these categories, drive incremental growth, loyalty points still apply, returns are easy through stores, should widen their digital net quite a bit.
Okay, this is where it gets really interesting strategically, because it involves something pretty high profile. Ulta and Target. They've mutually agreed not to extend that shop-in-shop partnership. It's ending by August 2026. Now, everyone agrees it was a successful collaboration in many ways, but the revenue impact, actually minimal. Less than 1% of net sales last year, though fair point, it apparently had a pretty nice flow through to EBIT margin, maybe 60-65%. Management says their other priorities, these new things you just mentioned, will more than make up for any lost royalties. Is this smart, or are they losing valuable reach? What's your take?
It's definitely a calculated move, but I lean towards it being shrewd, actually. That tiny revenue contribution tells you something, right? It was good for visibility, maybe, but not a core growth engine. By stepping away, Ulta gets full control back over the brand experience, the products they feature, everything. And they can funnel the resources, the capital, towards Space NK, towards wellness, towards the marketplace things they fully own and control. It feels like they're optimizing for profitability and brand integrity, betting these new ventures have a stronger long-term path. It's a trade-off, prioritizing own growth.
And kind of in line with that, thinking about resource allocation, they're also dialing back their U.S. store growth plans. For the next 2-3 years, they're now aiming for 50-56 net new stores a year. That's way down from the 150-160 they talked about before for that period. They're saying it's not lack of ambition, it's costs, rent, insurance, maintenance are higher, plus good spots are harder to find. Seems like a practical adjustment to reality, not just growth for growth's sake.
Absolutely. It's pragmatic, very much so. Building stores just getting more expensive. Finding those A-plus locations is tougher. So slowing the physical expansion lets them put that capital to work more efficiently elsewhere, like international, wellness, digital. The areas we've been talking about that likely offer better returns right now, it's about optimizing that return on capital, making sure every dollar is working hard.
Okay, so let's connect all this back to the outlook, because Ulta actually raised its full-year guidance for fiscal 25. Consolidated net sales now expected between $12.0 and $12.1 billion. Comp sales growth, 2.5 to 3.5%. Operating margin, 11.9 to 12.0%. And diluted EPS, $23.85 to $24. That all sounds positive. So why the caution we keep talking about?
Right. So the full year looks better, but management was very specific about being constructive but cautious for the second half of the year. They expect comp sales in H2 to be flat to maybe up low single digits. That's a definite slowdown from the first half. And here's the part investors likely focused on. Operating margin in the second half is projected lower, between 10.7% and 10.9% of sales. Why? A few things. Higher incentive pay because the first half was so strong, shifting some investments from H1 to H2. And just lapping easier expense comparisons from last year. So they're basically signaling things are normalizing, still healthy, but with some near-term margin pressure. Industry-wise, beauty is holding up okay, stable low to mid-single-digit growth, doing better than some retail sectors. But they know competition is fierce. Sephora, Amazon, TikTok Shop, it's always there. Ulta believes its loyalty program, its wide range of products, its omni-channel setup are its key differentiators. They have to keep pushing those. And they repeated their view on margins, around 12% operating margin. That's what they see as a realistic steady state now, which, importantly, is below the 14-15% peaks they hit before. It signals a kind of new normal for profitability. The focus now seems less on hitting those peak margin rates and more on driving absolute operating profit dollars and getting good returns on their investments.
Okay, so pulling it all together for you, the listener, we had this strong Q2 beat, raised full-year guidance, but the stock still dropped over 7% the next day. Trading volume shot up. We called it sell the news. But why do you think the market reacted like that, prioritizing the worries over the wins?
It really looks like investors zeroed in on that cautious H2 commentary, specifically the lower margin outlook for the second half. And maybe that messaging around 12% being the new long-term normal for operating margins. That forward-looking caution, especially about margin normalization, seems to have just overshadowed the strong Q2 sales. It prompted a rethink of the stock's near-term prospects. Seems like the market's putting a higher weight on future profit margins and maybe a more moderate growth path than on the current sales momentum. For now, anyway.
All right, now it's time for our This Is Not Financial Advice segment, where we brainstorm an outrageous, maybe plausible trade idea. What have you got for us?
Okay. All right. Let's stitch together these strategic threads. You've got Space NK for international growth. You've got the big push for wellness to become a billion-dollar segment. You've got the new online marketplace coming. Meanwhile, the market's hung up on near-term margin pressure and the Target exit noise. So here's a thought, purely hypothetical, of course. A long-term play. Maybe a bullish call spread on Ulta looking out to late 2026. What's the thesis? By late 2026, the dust from the Target separation will have settled. We'll have a much clearer picture of the Space NK integration and those wellness and marketplace initiatives. They'll have had time to potentially show real, tangible, maybe higher margin incremental growth. Think about it. They're shifting capital from slower U.S. store growth into these potentially faster-growing diversified ventures. Add in their strong loyalty program and omnichannel backbone, maybe Ulta demonstrates a whole new sustainable growth story. The market's current focus on short-term margins might be missing this longer-term strategic repositioning. If these initiatives gain traction and prove profitable, you could see a significant re-rating of the stock. It's a bet on that pivot succeeding.
Okay, so to wrap up our deep dive today, Ulta Beauty, a really powerful Q2, no doubt, driven by that Ulta Beauty Unleashed strategy, plus ambitious moves into international markets, wellness, and online marketplaces. Lots going on. But despite the strong results and the raised full-year outlook, management's caution about the second half, especially on margins, led to that sell the news reaction in the market. So what stands out to you listening in? How do you view these big strategic shifts? How do you personally weigh that near-term caution against these longer-term growth bets? As always, remember everything we've discussed here is just for informational purposes. It is definitely not financial advice. We always encourage you to do your own homework and talk to a qualified financial professional. We'll be watching closely to see how Ulta's story unfolds. Their next update, Q3 results, should be in early December. Thanks for joining us for this deep dive.